Let me be blunt. If you're over 60 and still buying stocks the same way you did in your 30s or 40s, you're not investing. You're gambling with time you no longer have. The market doesn't care how old you are. It doesn't care how much you've saved, how hard you've worked, or how scared you are about running out of money. It will take your capital without blinking, especially if you hand it over in the name of excitement, revenge, or hope. At 30, you can bounce back from stupidity. At 60, stupidity is fatal. I've seen too many people, good, decent, hardworking people, blow themselves up right before the finish line. They spent decades saving diligently, only to throw it all into some speculative mess because they wanted just a little more. They chased a hot tip. They followed a flashy YouTuber. They confused motion with progress. And just like that, 30 years of work gone in 30 months. If that sounds harsh, good. It's supposed to, because no one else will say it to you this clearly, and I'd rather offend you with truth than comfort you with lies. There is still time. You can still win, but not by doing what everyone else is doing. Before you buy another stock, stop. You need to understand what stage you're really in and how different the rules are now. If you're over 60, let's get honest about the math and the biology. You don't have 30 years to recover from a catastrophic mistake. You don't have a second career to rebuild your net worth from scratch. And let's face it, your energy, focus, and appetite for volatility aren't what they used to be. That's not an insult. That's reality. It's what time does to all of us. Now, that doesn't mean your investing days are behind you. Not at all. But it does mean the strategy you use must change because your margin for stupidity is shrinking. See, most financial media talks to a 30-year-old. They tell you to be aggressive, to stay in the game, to ride the volatility. That might make sense when you're 30 with decades ahead. When you're 60, you don't ride the volatility. You get bucked off the damn horse. Let me paint the picture. If you have $400,000 saved and you lose 40% chasing some hot sector, that's $160,000 gone. At 35, you might recover that with higher earnings or side hustles. At 65, you're just stuck. You don't get a second lap. You either preserve your capital or you start cutting back on retirement plans or working longer than you ever wanted. Now here's the good news. If you stop doing stupid things and start using filters that protect you from yourself, it's still possible to come out ahead, not with excitement, but with endurance. You don't need to find the next Tesla or time the market top. You need a strategy built around not losing. Because at your stage, survival is success. And the moment you fully accept that, the game changes. This script isn't for young day traders. It's for you, the investor who's in their 60s or beyond, sitting on real savings, wondering how to protect and quietly grow it without gambling the life you've worked for. You don't need more IQ. You need a different playbook. Let me tell you about Frank. Frank was 64 when I met him, spent his life as an engineer, smart, cautious, detail-oriented, saved like a man possessed, lived below his means, retired with just over $900,000. Solid number, no debt. He should have been coasting, but he couldn't help himself. Frank got bored. Retirement felt slow. CNBC ran 24/7 in his house. He started following a few forums, watching guys half his age flip tech stocks. They looked so confident, so certain. So Frank started playing. It started small, a few thousand here, a few thousand there. Then came options, then leverage, then margin. By the end of year 2, he'd lost nearly $400,000. You know what hit him hardest? It wasn't the money. It was the shame. The look on his wife's face when he told her. The way she didn't even get mad, just quiet. You don't forget that look. Frank didn't need a better stock screener. He needed a stronger filter between his emotions and his capital. He didn't blow up because he was dumb. He blew up because he forgot the stage of life he was in. He let envy, ego, and boredom hijack his strategy. And here's the irony. If Frank had done nothing for those 2 years, just left his money in a boring balanced portfolio, he'd be over $1.1 million by now. But that's the thing about compounding. It rewards the patient and punishes the distracted. Now, let me flip it. Let me tell you about Julia. Julia was 61 when she retired, worked 30 years as a school principal, not flashy, not a math whiz, but wise. Oh, she was wise. She told me once, I treat my money like a fragile heirloom, not something to show off, something to preserve. Julia had about $600,000. She split it between simple index funds, short-term bonds, and a cash buffer. She rebalanced once a year, ignored the noise, didn't even own a brokerage app on her phone. 15 years later, still retired, still stable, still sane. Her portfolio didn't triple, but it didn't need to. It grew just enough, and she never had a panic attack along the way. Two people, same starting decade, same broad resources. One sought excitement, one sought endurance. Guess which one slept better? The 7 silent killers of late life wealth. Let's get right into it. If you're over 60 and you're still trying to grow wealth, your greatest threat isn't the market, it's your own behavior. Over the decades, I've seen 7 recurring patterns that destroy older investors. I call them the 7 stupidities. And if you recognize even one of them in your behavior, it's time to wake up. 1. Chasing hot stocks and trends. You're watching the news. Everyone's talking about AI or crypto or clean energy, and suddenly you feel like you're missing out. The stock's already up 400%, but you think maybe it'll go up another 400%. So you buy. You buy at the top. You buy when it's overhyped. And when it crashes, you're the last one holding the bag. At 30, you can laugh it off. At 60, that loss comes out of your future food budget. Hot stocks are not for people with cold time horizons. Period. 2. Using leverage or margin. Leverage is gasoline. It makes the car go faster. But at 60, you're not in a race. You're carrying your grandkids in the back seat. One market correction, one earnings miss, and your leveraged position becomes a forced liquidation. You don't just lose money, you lose control. It's financial Russian roulette. And yet, retirees fall into it all the time, thinking it's a smart way to juice returns. No, it's a dumb way to blow up what took you decades to build. 3. Taking advice from the wrong people. Let me be blunt. If the guy giving you stock tips hasn't personally managed money through at least 2 major crashes, he's not qualified to guide your retirement strategy. You don't take medical advice from TikTok. Why take financial advice from a 26-year-old day trader who's never seen a real recession? People over 60 need filters, not just for stocks, but for voices. Wrong inputs equal painful outcomes. 4. Ignoring simplicity. The older you get, the simpler your portfolio should become. But most people do the opposite. They start adding complex ETFs, option strategies, dividend arbitrage, international exposure they don't understand. They confuse complexity with sophistication. You're not managing a hedge fund. You're managing your sanity, and simplicity is sanity. 5. Not understanding what you own. You ask, what's this fund? They say, it tracks small caps with smart beta filters using dynamic rotation. You nod. You don't want to sound dumb, but here's the thing. If you can't explain what you own in plain English, you shouldn't own it. Blind investing is just speculation in a suit. At 60 plus, that blindness is expensive. 6. Letting ego drive decisions. You think, I'm smarter than average. I can handle a little risk. I can time this better. Ego is a silent killer, especially for people with above average intelligence. The market doesn't care how smart you were in your career. It's not impressed by your degrees or your instincts. It only cares whether your process is sound or fragile. And most ego-driven investing is fragile. 7. Acting out of boredom or fear. This is the big one. You retire, life slows down, markets move, and suddenly trading becomes your entertainment or your coping mechanism. You buy out of fear, you sell out of boredom, you act not from logic, but from emotion. That's not investing. That's therapy with your money, and it never ends well. At 60, every mistake costs more in money, in time, in emotional resilience. Recognize these stupidities. Name them. Build systems to avoid them. You don't need brilliance. You need to avoid catastrophe. And the first step is knowing where the landmines are. Core rule. Never risk what you can't rebuild. You want one rule that cuts through the noise, one principle that simplifies every decision you face in your 60s and beyond? Here it is. Never risk what you can't rebuild. This is not just a financial rule. It's a life rule. When you're young, you can rebuild with energy, with time, with career upside. But when you're older, your greatest asset isn't time. It's what you've already built. And the only rational path is to protect it like your life depends on it, because in a very real way it does. Let's break this down. The silent killer of late life risk. Let's say you're 62 years old. You've saved $500,000. Not bad. That's more than most. You want to grow it, of course. But you also want to draw $20,000 per year from it to supplement Social Security. Let's do some quick math. If you earn a modest 4% per year and withdraw $20,000, your capital barely shrinks. You can live modestly, securely for 25 to 30 years without much stress. But if you take a 40% hit chasing some innovative disruption fund that crashes in year one, your $500,000 becomes $300,000. Now try drawing $20,000 per year. You're out of money in 10 years. And then what? See the trap? At this stage, losses hurt exponentially more than gains help. Recovering from a 40% loss takes 66% gains. That's hard for anyone, let alone a retiree. So when you're tempted to swing for the fences, remember, it's not about hitting home runs. It's about staying in the game. Why we ignore the rule? Here's the real problem. Even though the math is clear, we still take dumb risks. Why? Because fear and greed don't retire. You see other people winning. You feel behind. You start to panic. What if I run out of money? What if I miss this opportunity? What if this is my last shot? The fear of not having enough, combined with the greed of wanting more, leads to reckless behavior. And here's the bitter irony. The people who fear running out of money the most are the ones most likely to take the kinds of risks that guarantee it. You're not behind. You're just listening to the wrong voices. The real game now is not maximizing wealth. It's minimizing regret. What this rule really means, never risk what you can't rebuild, isn't just about avoiding bad trades. It's a worldview. It means you accept your stage of life. You stop pretending you're 35. You embrace the quiet dignity of preservation. It means you would rather be boring and solvent than exciting and ruined. It means saying no to things you don't understand. It means being okay with watching other people get rich faster and not letting that envy poison your decision-making. This is maturity. This is wisdom. This is what most people never reach, no matter how old they get. And if you can internalize this one rule, truly make it your compass, you'll not only survive the next 20 years, you'll do it with your sanity, your dignity, and your freedom intact. If it doesn't pass the checklist, it doesn't touch your money. Let's get tactical. Philosophy is the foundation, but filters are the defense system. You need a checklist, a personal investment firewall that protects you from both the market and from yourself. Every decision should pass through these gates. If it fails even one, walk away. Here's the checklist I give to every investor over 60 who asks, what should I do next? 1. Can I explain this investment to a 12-year-old? If the answer is no, walk away. Clarity is protection. Complexity is often a mask for risk. Example, if you say, this ETF rotates momentum-weighted assets using volatility triggers, you're already in trouble. Instead, I own U.S. companies that grow steadily, and I rebalance once a year. That's sanity. 2, would a 2008-style crash wipe me out? Test every portfolio against pain. If a 40% drawdown forces you to sell at a loss, it's not a portfolio. It's a time bomb. Design your allocations assuming the worst. If the plan only works in blue skies, it's not a plan. 3, does this asset produce cash or just hope? Too many people own things that only rise if someone else is willing to pay more. You want cash flow, not just appreciation. At 60 plus, dividend-paying stocks, interest-bearing bonds, or simple annuities bring sanity. Hope doesn't pay the grocery bill. 4, am I buying this because I'm bored, scared, or greedy? Ask yourself, what emotion is driving this decision? If it's boredom, take a walk. If it's fear, pause. If it's greed, slap yourself, gently but firmly. Emotional decisions are almost always expensive. 5, does this asset match my time horizon? If you'll need the money within 5 years, it should not be in stocks. That's not conservative. That's just smart. Cash and short-term bonds exist for a reason. Don't let opportunity cost become a justification for taking dumb risks. 6. Is this investment aligned with my life stage? The question isn't, is this a good investment? It's, is this a good investment for someone in their 60s? The answer changes with age. What was aggressive at 30 may be reckless at 60. Tailor your tools to your timeline. 7. Would I be okay holding this for 10 years if the market closed tomorrow? This is Buffett's favorite filter, and one of mine too. If the answer is no, you don't understand it, or you don't really believe in it, and both are disqualifiers. 8. Is there a simple, cheaper way to get the same exposure? If you're paying 2% fees for something an index fund could do, for 0.04%, you're donating money to Wall Street's yacht fund. Most complexity is fee extraction in disguise. 9. Am I trusting a salesman or a system? If your financial plan is built on the charisma of a single person, even me, you're not investing. You're gambling on trust. Build systems. Use rules. Be ruthlessly skeptical of people selling you peace of mind in exchange for your liquidity. 10. Does this give me peace or agitation? When you check your portfolio, do you feel a calm sense of clarity or a rising pulse and the need to adjust something? If your portfolio makes you nervous, it's not just a financial problem, it's a life problem. Fix it before it bleeds into your health and relationships. If you're over 60, this checklist should be printed, laminated, and placed next to your computer because excitement is expensive and peace is a better benchmark than performance. What if I'm too late? What if I don't have enough? What if I'm wrong? Let's tackle the myths that keep older investors spinning their wheels. These questions come up constantly, and most of the answers you hear online are either too vague, too optimistic, or dangerously wrong. I'm going to tell you what actually works, from real numbers, real portfolios, and real retirees. Myth number 1, should I pay off debt or invest? The answer is pay off any debt over 5 to 6% interest before you invest a single dime. At your age, guaranteed savings beat speculative gains. If your mortgage, car loan, or credit cards are draining cash every month, that's a guaranteed loss. And you can't afford losses right now, guaranteed or otherwise. Yes, the market might return 8% this year, but paying off 7% interest debt is a 7% risk-free return, and risk-free is a luxury most 60-year-olds need more of. Myth number 2, $250,000 is too small to matter. False. Let's say you're 62 and you've saved $250,000. You feel behind, but let's walk it out. If you invest it conservatively, say 4% average return, that's $10,000 a year. That's $833 a month. Add Social Security, cut unnecessary spending, and you can absolutely build a stable, quiet life. But if you panic and try to double that money fast and lose 40%, now you're left with $150,000 and no margin of safety. Remember, money that's still there is more powerful than money that was once there and is now gone. It's not too small, but it is too fragile to mess around with. Myth number 3, I'm 55 or 60. Isn't it too late to start investing? Too late for what exactly? Too late to get rich quick? Yes. Too late to build safety, stability, and dignity for the next 30 years? Absolutely not. You don't need 30 years of compounding. You need just enough to stay out of fear. Let's say you start at 60. You have $100,000. You add $10,000 per year. You invest at a 5% return. By 70, you have over $250,000. By 80, you have $450,000 without ever swinging for the fences. Slow, consistent effort works, even late. The key is stop comparing your starting point to someone else's highlight reel and start optimizing for what's still possible. Myth number 4, this market is different. I need to adapt. Yes, markets evolve, but human behavior doesn't. Every generation thinks their moment is unprecedented, that this time the rules have changed. But fear, greed, overconfidence, and envy are constants. And so are the consequences of chasing hype, ignoring math, and throwing away risk management. Don't confuse noise with truth. Stick to timeless principles. They outlast every trend. Myth number 5. If I don't do something bold now, I'll miss out. Let me ask you, miss out on what? Volatility, anxiety, watching your savings bounce like a yo-yo? You're not building an empire. You're building enough. You're not trying to catch up. You're trying to stay sane. Boldness is for people with time to fix mistakes. At your stage, the bold move is not playing the bold game. Let the young chase dragons. Your job now is to cross the bridge with what you've got, carefully, wisely, and with both hands on the rail. But what if I already messed up? What if I don't have enough? Let's pause and talk directly to the investor who feels like they're already too late. Maybe you're 63 and your savings don't look like they should. Maybe you made some mistakes, trusted the wrong person, bought the wrong stock, ignored the market too long. Now what? The temptation is to panic, to think, I need to make up for lost time. But that mindset, trying to win back 20 years in 20 months, is exactly how older investors blow themselves up. Here's the truth. It's not too late, but it is too late for heroics. You don't need to catch up to anyone. You need to get stable and protect the years you still have. Let's walk through a few late starter scenarios and what actually works. Scenario 1. I'm over 60 and I have very little saved. First, breathe. Shame doesn't help. The worst thing you can do right now is swing for the fences out of guilt. Start where you are. Here's your playbook. Build a 6 to 12 month cash buffer, even if it takes a year to get there. Pay off high interest debt, no exceptions. Start automatic monthly contributions to a simple low cost index fund. Forget doubling your money. Focus on building resilience. If you can reduce expenses, increase income even modestly, and avoid losing money, you'll buy yourself time. And time is still your ally, even at 60. Scenario 2. I have savings, but I'm scared of another crash. Good. Stay scared. Just don't be paralyzed. Fear can be useful if it keeps you from taking dumb risks. Here's how to think about it. Split your portfolio into 3 buckets. 1, cash, 1 to 2 years of expenses. 2, conservative bonds or CDs. 3, equities, diversified, low fee, no single stock bets. This structure means a crash won't force you to sell. You'll have liquidity, safety, and modest growth in that order. And remember, volatility is not the same as risk. Risk is having to sell at the wrong time. Volatility just means your screen is yelling louder. Scenario 3. I'm still working, but can't save much. Then every dollar saved matters even more. A late starter has to optimize for efficiency. Use a Roth IRA if you qualify. Tax-free growth is a gift. Cut expenses with intention. Eliminate the non-essential. Invest automatically, without emotion. Don't try to jump 10 rungs at once. Climb 1 rung per month. In 5 years, you'll be 60 rungs higher and still holding the ladder. Scenario 4. I feel embarrassed. Everyone else seems so far ahead. Let me say this clearly. No one's ahead of you. They're just playing a different game. You don't know their obligations, their risks, their mistakes. All you control is your inputs, your habits, your emotions, your choices. And you'd be shocked how much ground you can cover with 5 boring, consistent years. I've seen people go from near zero to complete control in under a decade, not by chasing big returns, but by eliminating stupid decisions. Dignity in investing is not about being flashy. It's about being quietly untouchable. And that's still within reach, even now. The world is loud, the path is quiet. If you're still with me, it means you're not just looking for tips. You're looking for something deeper, something solid, not another flashy strategy, but a way to think, a way to be in the financial world without letting it consume you. Let's go there. The quiet rich versus the loud broke. In my decades of observation, the richest, and I mean truly rich, investors are almost invisible. They drive modest cars. They rarely talk about money. They know exactly what they own. And they have one common trait: peace. Compare that to the ones constantly talking about opportunities, alpha, the next 10x play. They're always chasing, always anxious, always one step away from ruin. One's playing the long game. The other's playing a game with no finish line. Ask yourself, which one do I want to be? Envy is a tax, and most people pay it willingly. If you want to destroy your investing future at 60 plus, here's how. Look at what someone younger is doing and try to copy it out of envy. It's not just dumb, it's suicidal. That 35-year-old posting screenshots of $10,000 gains. He's also posting $20,000 losses, just not on Instagram. Comparison poisons good decisions. It makes you trade a stable 5% return for a lottery ticket with your retirement money. Charlie Munger once said, "It's not greed that drives the world, it's envy, and envy has no upside. None. If you want to be financially sane at 60 plus, eliminate envy like you'd eliminate termites. It eats from the inside." financial pornography, and the cost of noise. Turn on YouTube. Top 3 stocks to buy now. Recession coming in 6 weeks. Is your money safe? It's all noise. And worse, it's designed to bypass your rational brain and hit your lizard brain. It's financial pornography. And it's just as addictive and just as harmful as the other kind. Every time you consume that content, you're reinforcing the idea that you need to do something right now. You don't. The best portfolios for people over 60 are designed to function in silence. No drama, no notifications, no need to check daily. Just systems quietly doing their job, like a well-built furnace in winter. The emotional weight of money after 60. Let's talk about the feelings no one wants to admit. The panic at 3 a.m. when the market drops 2%. The shame of not having enough at your age. The regret over that one big mistake. The guilt of needing to be careful when your kids expect freedom and fun. I've sat across from dozens of people in their 60s, 70s, 80s, strong people, who broke down when they realized how emotionally heavy their finances had become. Not because they were greedy, but because they were scared to mess up what little margin they had left. So let me say this as clearly as I can. You are not behind, you are not broken, and you are not alone. You are just at a stage where clarity matters more than confidence, where wisdom matters more than bravado, where preserving is the new winning. This is not the time to impress anyone. This is the time to protect your peace, protect your capital, and protect your future. And you can, not with brilliance, but with boring filters, not with speed, but with stillness, not by playing the game harder, but by leaving the wrong game entirely. That's the real secret of money after 60, knowing which games are no longer worth playing. The bravest move you can make now is to stop trying to be brave. Let me leave you with something sharp, something that stays with you. If you're over 60 and you still think the solution is to do more, to catch up, to take one last shot, then you're still trapped in the wrong mindset. You don't need one more big win. You need fewer regrets. You need fewer variables. You need fewer opportunities to sabotage yourself. The real win at this stage is control over your behavior, your environment, and your expectations. That's what financial freedom actually means now. Not yachts, not market timing glory, but the ability to sleep well, make decisions slowly, and never wonder if you've made a fatal mistake. You don't need excitement, you need endurance. You don't need access, you need insulation. You don't need to prove anything. You need to preserve everything. And yes, boring portfolios win. Yes, simplicity outlasts complexity. Yes, peace is more powerful than performance. You don't have to chase, you don't have to swing, you just have to not blow up. Because if you get that right, if you quietly sidestep the traps, if you stick to timeless filters, if you protect what you've built, then you've already won. Before you buy another stock, look in the mirror and ask, am I risking something I can't rebuild? And if the answer is yes, walk away proudly. That's not weakness, that's mastery. That's what Charlie Munger would do. That's what the wise do. And that's what you must do if you want to stay rich in what matters. Be calm, be boring, be here in 20 years. That's the new wealth.